Welcome back to Turning Hard Times into Good Times. I am your host, Jay Taylor, and I'm really pleased to have with me once again Dr. Robert McHugh. He's the editor of Technical Indicator Index newsletter. It's an excellent newsletter that I've been subscribing to for quite a few years now. Almost on a daily basis, he provides some great updates in the markets, his latest technical tools that he shares with his subscribers, and I found him to be very valuable. Robert was the founder of a regional bank outside of Philadelphia a number of years ago, and that bank was then acquired by a larger regional bank. But Robert continued to use the tools. He traded the bank's portfolio, did investments for the bank, and has continued to use those same tools and expand on them after leaving the bank. And so his service, I think, is one of the most valuable technical services that I've ever seen. And Robert also provides some good insights from a fundamental basis as well. So, Robert, I'm really pleased that you could be with me again today.
Thank you, Jay. It's always a pleasure chatting with you.
Always good to talk with you. I should mention before we get into some of the questions that I have for you, tell our listeners that the place to go to learn more about your work is technicalindicatorindex.com, right?
That is correct, yes.
All right, you can go there and you can sign up for a subscription. Robert has a couple of different levels of subscriptions. The one that I use is a more common one that is, I think, very reasonable in price. And the other one is very reasonable, too, if you're in a position to take advantage of his trading advice. In fact, I would imagine a lot of your subscribers, Robert, get their investment back rather quickly with some of the results I've seen you talk about. Anyway, let's get into this market. I mean, it just seems like the equity market is going to go up forever, Robert. And you've made some predictions over the past few years based on your Elliott wave analysis and a host of other tools that you use. One of the most picturesque tools is the jaws of death formation in the equity markets. And as you document very thoroughly, not only in your newsletter, but a book that you've written, The Coming Economic Ice Age, these formations are usually very ominous because almost always they seem to be followed by major downsides in equity prices. How are you seeing things now? I mean, you've been talking about this for some time. Equity prices don't seem to be going up a lot, but they're not going down either. So what's your read on this equity market now?
Well, the jaws of death pattern, the huge megathon pattern it's actually almost 30 years old now, from the late 80s, is still staring us right in the face. It's still very valid, and we are either finishing the top of it or we have finished the top of it with the mid 2015 highs in the stock market. That may have been the top, and we're just getting warmed up and ready to roll on the downside. Every major average, almost every single major average, remains below their 2015 highs, and a lot of the recovery, the rally we've seen recently is just a partial retracement of prior declines since mid 2015, and that's normal. Markets never go straight down; they never go straight up. They zigzag, and what we have so far is very possibly simply a wave 2 correction rally that is finishing off an oversold condition, and once this market is oversold or overbought, the rally will end and we'll head back down. And that could happen very soon. There are some indications that there is a short-term top, at the very least, approaching rapidly here.
Well, the Federal Reserve and central bankers around the world want us all to believe that they are in control. And, it seems as though whenever the equity markets start to go down, we hear from Miss Yellen and she's going to pump more money into the system, or she's saying, oh, no. No, I guess the data isn't strong enough. We can't really raise rates yet. We're going to keep pushing money into the system for now. Tomorrow never comes, it seems, Robert, but the central bankers seem to think that they can just continue to pump money in the system and hold the system together, keep equity prices from plummeting. You're a skeptic about that.
Yeah, I am, because all it's doing is creating hyperinflation that they're not recording. The price of food, the price of all necessities has gone sky high. And so, medical care, food, until recently, gasoline, oil was way up. The real estate prices are rising again, and I think they're just creating another inflation bubble. I don't think that it's showing up in wages. I don't think it's showing up in earnings. And so there's a squeeze happening where the cost of living is up, and the means to deal with that cost of living rise is not there. So a lot of people are feeling squeezed. I think that's evident in the political race we're seeing right now in both parties. How disenfranchised people are in both parties, and they're choosing to go in a completely opposite direction to what tradition has seen. And I think that's an evidence that people in the trenches, the everyday man, is feeling that the Fed's policies have not included him or her, and that the policies are failing, and it's leading to political unrest. And in my book, I mentioned that one of the problems with economic decline and economic struggle is that it leads to political change, political unrest, and it can change our very way of life. And I think the evidence is here in this political election. We have a socialist who may end up being the Democratic leader, the nominee. It's possible. That's incredible when you think about it. He's getting an awful lot of people that want him to give them free everything, free services, free college, free this, free that. Somebody's got to pay the price. Somebody's got to pay the bill. And the people that don't understand economics, which are a majority of people in our country, unfortunately, don't understand. Somebody's got to pay the piper, and it's going to be in higher taxes, which is just going to squeeze the standard of living even more. I mean, communism and socialism was tried for a long time, and it failed. And it seems to be a very big move in that direction in the United States. And I think that's a statement that the Fed's policies have completely failed our country and have not been capitalist supporting policies.
Well, it certainly hasn't been. I have to ask, Robert, how can you have capitalism when you don't allow the price recognition for capital itself? In the case of quantitative easing, massive amounts of money and obvious manipulation of the interest rates, which don't allow capital, which is really the savings, that amount of income that's not spent, right? And it just seems to me illogical to expect that you're not going to destroy capitalism if, in fact, you're not allowing capital to be properly priced.
Yeah, that's a great point.
Now, one of the points you made after the 2008-2009 debacle was that if they wanted to really give the economy a boost, rather than putting a bunch of money into the balance sheets of bankers to help cover up their sins, if they had taken the same amount of quantitative easing and provided what might be called helicopter money in some sense, put that money into the accounts of all Americans, we could have really had an economic period of economic growth. You still have that same view?
I mean, it's too late to do it now.
Yeah.
Because the Fed's balance sheet, it can't handle it. They already spent that bullet. But yeah, back in the day, right after the Great Recession of 2008, 2009, had they given everybody what I call a tax rebate, an income tax rebate, where they refund everybody's prior paid taxes. It's no different than the philosophy of lowering income taxes now to stimulate economic growth. It's putting money back in the hands of the everyday man and woman and businessman to apply that money that's in their best interest, and and it allows them to reduce debts and to make purchases and take business chances and expand businesses and so on. And that's the benefit of capitalism. It would have been such a boost to our economy. It would have been real growth. There would have been real building and construction. And it's just an empirical observation, but the $5 trillion that ended up in Manhattan, it has created enormous super inflation in the tentacle areas, the surrounding extended areas of Manhattan.
Well, for sure.
New Jersey and New York and Connecticut and even Pennsylvania, real estate prices are ridiculous in some areas. They've gone through the roof. The cost of living in those areas is absolutely not unbelievable. But I don't think the benefit of all that money going to Manhattan has helped anybody else throughout the rest of the country. It hasn't really reached out, and that was a false economic policy decision by the Fed that I think is leading to the ruination of this country, and it may even end up changing this nation from a capitalist nation to a socialist nation. And like I said in my book, I warned that the policies that were being followed were going to lead to major political change to the point where our way of life as we know it could change drastically. And whether that happens this election or not, that is the trend, and it needs to be reversed, and something needs to be done to get our country. I mean, any business program in our country nowadays, almost every single business department, every educational institution at college level or university level, the economics are being taught by socialists.
Yeah.
The textbooks are socialists.
Absolutely.
The professors are socialists. I mean, I went to, and I think you did too, Jay. I mean, I went to economics courses in several universities. I've had a ton of those courses, and every single one of my professors was a socialist.
Absolutely.
I had to butt heads with every single one of those professors to get my point of view, the capitalist point of view, across. And when I was a young kid, I didn't understand why we weren't gelling. And then as an older, mature man now, I say, oh my gosh, I was being taught by socialists, and I'm a capitalist American. And the problem is that thinking has bled through the youth. I mean, the people who are supporting Bernie Sanders, so many of them are young kids that are in college, and they're buying into this socialist thinking, this socialist preaching that's going on in the business course.
Right.
And that's the problem. The whole philosophy of our country is being turned upside down, and I think the Fed had a big part to do in it, because the policies of the Fed and the government during crises were not capitalist policies to fix the problem. They went with a top-down, give it to the bankers, and I almost wonder if it was done on purpose.
Well, it would certainly seem that way to me, Robert, in that Keynesian economics, which is, of course, I call it communism light, was really really came out of the out of an institution. I'm trying to think of the name of it now, out of London, which had no differences. In theory with the communists. It was only how to get there. Instead of through the barrel of a gun, was to be through an indoctrination process, and it certainly, as you point out, has been going on. I actually did have one professor. I'm older than you, I believe, but it was going back to a few courses I took years ago in the late 60s or early 70s at Fairleigh Dickinson. I had an economics professor that was a free market economics professor. But after that, I agree. Everybody has been really socialist and so on, and anti-free market, anti-capitalism. And we know from history that capitalism creates wealth. So, I guess people want to take the easy way out, Robert. They don't want to take responsibility for their own lives, their own mistakes. They want to basically have someone else take care of them and then blame anyone else for when things don't go well. But in any event, let's get back to it's good to cover these fundamental issues for sure, and you and I are in complete agreement with that. But getting back to some of your technical work, because that's the foundation upon which your service is based, and at least the tools and the practical side of it. You talked a lot in the past about Hindenburg Omens. Could you talk very briefly about what a Hindenburg Omen is, and are there any on the clock at the present time? There
are not any on the clock at the present time.
That's a good thing.
At this moment it is good for the market that there is not one. The Hindenburg Omen is a set of circumstances that sets up in the market from time to time. I would say on average maybe we see one once a year, where when it arises, there's about a 25% chance that a stock market crash will follow within a 3-month period. It's had a pretty good track record. It's about 1 out of 4 times. We did have one before the August crash last summer, and we did have one before the January plunge this winter. And so, we keep an eye on that, tracking that, and it measures a condition in the market that is unstable, that is susceptible to an overextended decline based upon any kind of black swan bad information that might show up in the markets. We saw that in January, and January's plunge was very severe. I mean, the S&P fell almost 300 points and lost, at least almost 15%. That was a huge plunge in January, and it shook up a lot of the market and eroded confidence. So that HO, the Hindenburg Omen, definitely has been spot on in giving us heads-ups about potential short-term plunges.
Robert,
nothing right now.
Robert, you note that there's a 25% probability of a crash, and you define a crash by what? What decline? 15%?
15% or more decline within a 3-month period is how I define it.
Okay, so there's a 25% probability that one will follow within 3 months. Have we seen any major crashes take place without Hindenburg Omens in the last number of years?
No, I haven't seen one. I mean, there might have been one that came close to that 15% level. I can't remember exact year. It might have been 3 or 4 years ago. But no, when you don't see a Hindenburg Omen, we're usually generally pretty safe ground for the moment.
Okay, Robert, one of the things that I've really been impressed with your work over the last number of months anyway, you have a couple of tools that seem to be working very, very well. One in particular called the Key Trend Finder that has really pointed people in the right direction of the stock market. You just mentioned we had that big loss, that big decline earlier this year, and I think your people made a lot of money on the short side of the market. Talk to us a little bit about the Key Trend Finder. What is that, and what is it telling us now? My
Key Trend Finder indicator is a combination of 3 indicators in combination when they all have a sell signal. That is a combined Trend Finder sell signal for the market. The lead indicator, there's one that's a little more heavily weighted and more valuable than the other 2, is what I call my purchasing power indicator. These indicators are measuring short-term momentum, and they're pretty good at identifying short-term trends, moves that could last anywhere from a week to 6 weeks following one of these signals. And yet, like you said, they have done a really good job in identifying movements over the last decade, really, since I've had them. Right now, we just got a new sell signal in this. So I'm on high alert that there could be a short-term decline in the market over the next 1 to 6 weeks. Yeah,
I think your Key Trend Finder, I think there are 3 different components to that, and all 3 have to be in agreement to give a directional signal, right?
Yes, if the 2 of them disagree with the third, then that's a sideways neutral signal. So we don't consider it a high momentum trend probability at that point.
And it's been good in both directions of the market, so that you've made money on the upside as well as the downside. And in fact,
we got a buy signal in mid-February on this indicator, and it rode most of the rally we've had in the last 6 weeks.
And just now you've gone the other direction. I believe it was neutral, and now on the weekend I saw that you had. It was giving your Key Trend Finder was giving you a negative, and just take a short position, perhaps, or at least be cautious, I guess.
Yeah, at least be cautious. I mean, people have to decide themselves if they want to be aggressive traders or they want to just, be cautious when the sells are on, and then maybe they go back in the market when the buys are on. It's just another contributing factor to their own decision-making process. Of what they want to do with their own portfolio. There's many other things people need to look at when they make decisions in investing and trading. Like another indicator I use that I really have found very helpful are bearish and bullish divergences that measure the direction of price versus an opposite reading in underlying strength of breadth in the market or volume or what I call demand power. Mm-hmm. So when I see these kind of divergencies along with my trend finder indicator, when they all line up, that's a pretty good high probability moment to take a position, either getting out of the market or going in a direction that you're comfortable playing.
Right. All right. Well, in summarizing then, with respect to the equity markets, I guess longer term, medium to longer term, it looks very bearish for you. Short term, it's a wait and see, day by day kind of thing?
I think short term, I do see a decline over the next 6 weeks. But but long term, I definitely see a major decline in the markets coming for sure, in a very, very big way that could last several years. When it gains momentum is up in the air at that moment. At this time, I can't tell you exactly when the high momentum drop in prices will happen, but it's set up for that.
Okay, let's talk a little bit about gold in the time that we have left. You seem to be quite bullish on gold at this point in time. What are your technical tools telling you that cause you to at gold favorably now?
Well, just tracking an Elliott wave mapping for gold, I'm very bullish because it looks like from September 2011 until just the end of last year, we completed a corrective, what I call correction wave 2 down. It was a lengthy one, but it's correcting an enormous bull market that's been going on for decades.
Yeah.
So, we peaked around 1900 in gold in September of 2011, and then we worked our way lower, and it was really a very mild correction in the scheme of things. It took us down about maybe 40%, something like that, from the highs. So it retraced about 40% of the move up, the prior move up. Mm-hmm. And that's a healthy correction. It worked out some overbought conditions. It kind of shook out some of the players that weren't really serious about hanging in there with gold. And now we're all set up for a really nice long-term rally. And I think gold is going to move in the opposite direction of the stock market. I think there is an inverse relationship there. And you look at the fundamentals, once the stock market starts dropping and the economy continues to decline, which I really believe will happen, they're going to have to, the policy of the Fed will be what they typically do, which is pump more money in the economy. And that's creating inflation and devaluing the dollar, and that's good for gold. So I think gold has a very bright future, and it's going to rally very, very high. Maybe it could reach 3,000 over the next 10 years, possibly in the next 5 years.
Robert, gold inverse to the stock market. Gold is generally inverse to the dollar, yet you've been generally pretty bullish on the dollar. Do you still see the dollar in bullish terms? Do you see the dollar getting stronger vis-a-vis other currencies? And if so, do you see a breakaway perhaps then between gold and the dollar from that inverse relationship that's been pretty well documented over a long period of time?
I think the dollar is going to decline in value at some point here. As they print more of them to deal with a coming financial crisis, that's going to devalue the dollar. And so gold will end up in an inverse relationship with both the dollar and the stock market, and both the dollar and the stock market could decline together. That's kind of how I see it shaking out, at least here in the United States.
All right. Well, look, in terms of the target prices for gold, we have a technical analyst on my show almost every week. This week he's not with us, but Michael Oliver uses different tools than you use. I think for the most part he uses what he calls his momentum structural analysis. It is a momentum-based tool, proprietary tool that he's used, but his view is that we are looking at he's turned very bullish on gold, and he sees something like 1450 as sort of the key resistance level before it runs into any trouble. Then he thinks that's not the end of it. I think he could see the kind of $3,000 number you're talking about over the next couple of years or so, several years perhaps. But 1450, does that look like as some kind of a level we might be shooting for in the next year or so?
Yeah, I think the rally's going to be stair-step, up, down, but higher each time. And 1450, I'm just looking at a chart here, that is a resistance point that was part of it's really the midpoint of the correction from September 2011 until it bottomed in late December in 2015. The midpoint of that correction was at the 1450 level around 2013. So that would make a nice resistance level for stock or for gold to reach, stop, and then correct from a little bit, and then continue its upward push after it does a correction from that level.
All right. And with respect to gold shares, I know that you also you look at the HUI purchasing power indicator and also the HUI 30-day stochastics. And if those two are in agreement, then you're bullish on the on gold shares. How are they looking now? How are gold shares looking to you right now?
Well, that trend finder indicator consists of two component indicators, and the one which has, I think, a little better credibility than the other is on a buy from last week. Mm-hmm. And then the second one, I'm watching this for it to turn to a buy. It's very close to hitting a buy. Maybe we'll see that today, since it's up today.
Yeah,
miners are up today. So I'm looking for short-term rally in mining stocks over the next 6 weeks, along with gold. They tend to correlate together, of course. So that's kind of exciting in the short run for gold and miners.
All right, very good. One more question. I know you've been quite bullish. I believe you've been quite bullish on U.S. Treasuries. It makes a certain amount of sense because, it's as long as people still have confidence in the dollar, it's a risk-off trade, right? If people go to the dollar, and to a certain extent, I think we're seeing more of that into gold now than we did in the past. But are you still relatively bullish on U.S. Treasuries?
Yes, I am. Just as the economy goes down the John, there's going to be a flight to quality. Gold is going to be one safe haven, and another is going to be the U.S. Treasury. We have the strongest military on earth. As long as we do, that's going to be a place that people seek out for safe haven. And almost every single financial crisis we've had over the past century, when people get scared, the Treasury goes up in value, interest rates fall.
Yeah.
And so I don't see why that would change at all over the coming several years, when I think this crisis is going to manifest itself again.
Oh, very interesting. It's certainly, I'm not sure that I'm happy about seeing us need a massively strong, aggressive military to, let's say, perhaps enforce the dollar, the petrodollar. I mean, on that topic, one quick one. Do you look at oil closely now? And if so, what are you seeing for oil? Because to me, it's all about the petrodollar and the United States. And ever since we went off the gold standard, Kissinger arranged with Saudi Arabia to buy to demand dollars for the sale of oil. And of course, now we're seeing Russia and Iran going in the other direction. They're not taking dollars any longer. They're selling their oil to China. But what are your technical charts showing you on oil, if you're following those closely now?
Well, I have a long-term chart for oil I'm looking at right now, and I think oil's bottoming. I think that oil will has a real strong up leg coming, probably in lockstep with the coming economic decline in stocks. I think there's some kind of crisis coming. If you look at all these different charts of these different markets, it's painting a picture of a crisis, and it may involve military crisis. There may be political and military events, but oil looks like it's bottoming. It's been in a rising trend channel I have here since 1990, and it's just reached the bottom trend line.
Interesting.
It's a well-defined trend channel. It peaked at the top of that trend channel in 2009, and it's just hit the bottom of that trend channel the last month or so, and bounced off of that, and it started up again. It's got over 40. And so I think, look at this chart. I mean, it's a ridiculous number, but if it hits the upside boundary of that trend channel, I mean, we could see $200 a barrel oil.
Wow.
I'm not calling that anytime soon. That would take years to develop, but the trend would be in that direction, and that tells me there's going to be problems, with the geopolitical environment in the world for that to happen. So
yeah.
It'll be interesting to see how that works out.
Well, it certainly will be interesting. Anything else you'd like to add before we conclude our discussion today, Robert?
No, I think we're in a weird year, with political election, and there's a lot of manipulation by the Federal Reserve. And, I don't know, maybe they'll hold off letting things fall apart for another 10 months, get past the election. Everybody's got an agenda. They've got a lot of manipulative skills. Absent some kind of a black swan out of the surprise, out of left field military event globally, I would imagine that this could be a muddle along type year where we go down quite a bit, then we go back up and down, get past the election. At that point, maybe we'd be in a position where what the charts are predicting, forecasting, will finally occur. I mean, could it happen before then? It could. But, I just think it's one of those years where we have to be careful in our investing and trading, because there are outside powerful forces that have an agenda that want to make sure that their agenda gets achieved, and in some cases that's the status quo.
Yeah, for sure. No matter what it does to the masses, I guess it doesn't. They could care less, probably. At least it seems that way to a great extent. Well, I want to thank you very much, Robert, for being with us again. Always valuable having you on, and I want to remind my listeners again, it's technicalindicatorindex.com. technicalindicatorindex.com. Robert writes prolifically, sends things out every day, and if you don't have the time to read it, he provides an excellent executive summary, which is what I usually rely on most of the time, and then take a peek at his numerous charts, almost every day. Always very great to have you, Robert. You're really a blessing, and we want to thank you for sharing your time with us once again.
Thank you, Jay. I really appreciate that, and I always enjoy speaking with you.